Good morning. We need to break out of our personal Egypt. I don't know if you've heard the story about Passover, but Passover traditionally is about the Jews leaving Egypt out of slavery and bondage. And one of the things that's really interesting about the Jewish tradition is that there is a concept of everybody has their own personal Egypt that they need to break from and they need to break free from. And I wanted to share with you one personal Egypt that I have found that I've been able to break out of that has been really helpful for me. And I'm hoping that maybe it could be helpful for you as an investor. Now, one of the personal bondages that I had was listening to the narrative and the story from all the pundits that I would hear on television or analysts telling me stories about why something should go up or why something should go down. And what I learned from experience and over time is that having discipline from a quantitative perspective, in other words, believe the numbers, that you actually can break free from the bondage of the narrative that can actually lead to you losing money and not making as much as you should. So some simple things can really help. So I want to use an example of how discipline can help you break from the bondage from listening to the narrative on the television and analysts and everything like that. So what I'm showing you right now is just a simple spreadsheet. This spreadsheet is linked to live market data, and it is linked to securities that are being followed to actually make sure that you don't get pulled into the wrong narrative and that you're following the right trends. Because it's so easy to listen to a story, and the story would be something like, oh, XYZ stock should go up because there is some form of new government regulation that's going to occur. But then the stock does absolutely nothing, or the bond does absolutely nothing, whatever the story may be. So what I'm going to do is I'm going to walk through a very simple process that can help a lot of people with their 401k or with their any other investment that they have that are invested in funds, like say you can't actually pick stocks, that could keep you on the right side of the table. So the first step in this kind of breaking away from the narrative bondage is to realize that the markets are vast and non-correlated, and that you don't want to have all of the same thing. A lot of people will wind up boatloading up in the same investments, even though they have different names, but they're basically highly correlated. So the first step is to actually create a universe of investments that are not correlated with each other. For example, US sectors and US styles that would be different, or international equity styles and commodity sectors and taxable fixed income. So that's the first step, is getting a non-correlated sector group. And then the next step is to say, how many risk units am I going to put on for each individual sector? So you might have five, you might have a maximum of five. You're going to pick the very best 5 sectors, very best 3 styles. And this is for people that are not picking stocks, right, or picking individual investments. Maybe you are in exchange traded funds, and that's all you have available to you in your plan. Commodities, how can you break down the commodities? Maybe you have 4, maybe you have taxable income, maybe you have 3. And then you say, okay, what percentage of my overall risk that I'm willing to assume am I going to allow to be in each one of these sectors? And what is my risk budget? And I'm going to try to maximize my return for the amount of variability that I'm willing to accept. And from that, you can create a risk budget for each one of these. And then you can go through a disciplined process of going through the universe that you're tracking. For example, in this one, these are the different US sectors that are being tracked. Consumer staples, energy, gold miners, financial, health, industrial, et cetera. So you take each one of them and you break them down into the very best funds or ETFs that are available in that group. And there's definitely a disciplined way of doing that. That's a whole nother discussion. But whittling them down to a universe that you're really going to follow. And then you monitor their volatility so that you know how much risk that you're taking when you do, or at least you have a good idea about how much risk you're taking when you do invest in them. That helps you size. And you create a maximum size that you're willing to accept based on your risk budgeting for each one of these investments. But you don't buy it unless it absolutely looks like it's a good buy. So, and there's lots of ways you can do that, but the idea there is you want to buy them based on factors that are based on evidence, not a gut feel, but something, a methodology that is based on facts that show that you can outperform. You have a higher probability of having a winner using this method, right? So, for example, in this one, this is a very simple model. This model shows that you could use trends and range breakouts, right, as a factor, and you can have time frames involved. So here, through a series of steps, each individual fund is analyzed for their trends and their factor ranks, and they're analyzed based on the factor that has shown to do well, right? And then from there, there's another thing that says, okay, look, is this investment trending up or not? You don't want to be in investments that are trending down. I see that happens too many times with people where they just keep holding something that's trending down. So there's a filter that monitors the trend. So there's a model for the absolute trend. So one is relative to each other, and the other one is absolute. So then you can get your buy signals. Like, okay, this particular one's a buy. Like right now, communication, consumer discretionary, energy, those are all buys. The industrials, the industrials are taking off. Why? Because there is a why behind it, right? But you have to see the numbers actually proving it, right? Well, you may have noticed there's a lot of talk now that there is infrastructure plays going on. Those tend to be industrials, and they've been ignored, right? And now they're starting to take off. And you've got your natural resource stocks. And then you actually make your buys from that, right? And you do that with each one. Now, there may be times where a certain sector, nothing is trending up. Like, for example, in the bond markets are not trending up very much. So you have a lot of buys on a relative basis, but very few sectors in the bonds are actually trending higher. Right now, it's only the junk bonds, the short-term junk, the lower quality bonds. So you might own more cash. So right now, in this particular model, there's more cash. My point is to not replicate this in one for one, but the idea is to say, I'm going to be disciplined using factors that are known to do well, evidence-based investing. I'm going to predefine my risk, and I'm only going to invest when investments are showing that they have the right characteristics and a higher probability of doing well. And then I'm going to properly diversify, and I'm going to allow myself to have cash sometimes, because there's times when you just must have cash. So that's really my thing I wanted to share with you today, because I think too many people rely too heavily on the story and not enough on the numbers. And you can break that down into the fundamental numbers for stocks. But if you have a company that has a great story, but there's no numbers behind it, no thank you, I'm going to pass. So that's one way to get out of your personal Egypt of underperformance in investing. So that's all I have for you guys today. I hope you're having a great day, and we will talk to you later.